This is the only bookkeeping tutorial you're gonna need if you are a beginner looking to set up a solid system. This is my free course giving you absolutely everything you need to get started. Here's what we're gonna cover. First, I'm gonna walk you through the basics of what bookkeeping and accounting are so you have a solid foundation. Then I'm gonna give you a live demo on exactly how to set up your bookkeeping. Then I'm gonna walk you through small business taxes as a beginner, share with you IRS receipt requirements, walk you through financial statements, and a lot more. By the end of this video, you'll have the ability to understand and manage your own bookkeeping. Or if you're looking for a business idea, hey, you might even be able to get your own bookkeeping clients as well. Now, before we jump in, if you don't know who I am, hey there, I'm Sean, a licensed tax professional who have been helping small business owners by educating them and helping them with their taxes for the last decade. If you're a small business owner watching this video and you need help with bookkeeping, tax preparation, or tax planning, consider clicking the first link down in the description below. Also, quick heads up for my long-term subscribers. This course is a compilation of my older videos along with some new ones I just recorded. All right, let's go ahead and transition with the basics of bookkeeping and accounting. When you start a new business, there's a lot of exciting things to do, like set up your bookkeeping and accounting. No? Is it just me? Okay, maybe not. Your accounting and your bookkeeping are probably not as important as figuring out a way to build your business up and acquire new customers. However, it is still very important to the health of your business long term because, without accounting, how would you know your monthly cash flow or how to budget for your salary or when to hire employees, for example? So bookkeeping and accounting is very important. So what I want to do in this video is help new founders and people who are in the process of launching a new business learn why you need bookkeeping and accounting, go through a checklist of what you need to get set up, and answer some common questions along the way. So if all that sounds good to you, then all I ever ask is for you to hit the like button for the YouTube algorithm so other people like you can learn how to set up their business accounting and bookkeeping processes. All right, let's go ahead and dive in with number one, the purpose of accounting and bookkeeping. So very often people commingle accounting and bookkeeping because they both involve numbers, right? But look, they're actually very different. Let me explain. So accounting is the process of interpreting or analyzing financial information. Okay, this is helpful when you're trying to make strategic business decisions like, can you afford to hire an employee? Or are you spending too much on software and tools? And how much should you pay yourself as a small business owner? Or even looking at what are my estimated tax projections for the next year? So accounting is all about interpreting financial data. But in order for you to get that data, you must do bookkeeping, which is the process of tracking all your financial reports, like recording all your sales and recording all your expenses and recording your liabilities or assets that the business acquires. And of course, bookkeeping and accounting go hand in hand. You need bookkeeping in order to do accounting. You need accounting in order to make smart financial decisions. For example, if you are trying to get a business loan or solicit investors, then more than likely they are going to want to see a clear and easy to read financial statement, even if it's just a forecast, so that they can make an informed investment about your company. Also, you will want proper accounting and bookkeeping processes in place so that when you go to file your business taxes, they can be on time and accurate. Okay, now that you understand that, let's move to number two and talk about your business entity. Now, if you've already launched your business, then chances are you have selected your business entity like an LLC, but you should know that your entity type can determine how you are taxed, how you pay yourself, your business risks, and a lot more. For example, a single member LLC cannot issue themselves a W-2. On the other hand, an LLC that is taxed as an S corporation must pay themselves a W-2 as a reasonable salary. So when you're doing your bookkeeping and your accounting, you have to know that your business entity may impact your process. Now, we have a few videos on this channel where we talk about different business entities and outcomes. So I'll link to some of those videos down in the description below and at the end for you to watch. For now, let's go ahead and move on to number 3 and talk about the 2 accounting methods. All right, it's my goal not to turn this video into some type of super technical accounting lecture, but I do need to talk to you about 2 accounting methods because you will come across this if you decide to do your own bookkeeping or accounting. Which, by the way, if you want to see me make a video on how to completely do your accounting and bookkeeping step by step, just tell me down in the comment section below, because this video is simply an overview. Anyway, so the 2 accounting methods are number 1, cash basis accounting, and number 2, accrual basis accounting. Let's talk about both of them. So the cash basis method is the simplest way to handle your accounting. It simply tracks income when it is actually received and subtracts cash when expenses are actually paid. And this is the way that most people think about tracking their income and expenses, right? Like they will want to track when the money comes into their bank account and then subtract it when it goes out. But this method does present a problem for businesses who are on a pay schedule with their customers and vendors, because cash flows do not necessarily reflect the proper timing for when income was received or made, which is why you have method number 2, the accrual basis method. So this method counts money when it is earned rather than when it is received. For example, if a customer pays you upfront for an annual service or subscription, even though the money has been received by you, it hasn't technically been earned. And so you wouldn't want to record it as revenue and pay taxes on it yet. Because, okay, something could happen with the product or with the service that prevents you from actually earning the rest of the revenue. I hope that makes sense, because these methods could definitely get confusing. But look, if you need help with accounting and taxes, then consider working with our team by clicking the first link down in the description below so that you can learn more about how we help you. All right, let's move on and go through a checklist of what you need to get set up. So the first thing you'll want to do is number 1, try to go through this checklist at least every quarter. Although most accountants will try to set you up with monthly bookkeeping, and if your business is really rolling and you have a lot of transactions, then you may even want to move to weekly bookkeeping. But of course, for most startups and new businesses, that's a little bit extreme, and quarterly bookkeeping should suffice. Okay, the second thing on my checklist is number 2, enter your transactions into a bookkeeping software or spreadsheet like Google Sheets. Now, most bookkeeping software like Quickbooks, affiliate link in the description below, will allow you to connect your bank account to the software. And so this will save you time from having to manually enter in all your transactions one by one. And I know this was something that I had to do for many years. However, even if you do decide to use this technology and automatically have your transactions entered, you still need to remember to enter transactions that don't occur in your bank account, like your cash transactions or when you are acquiring an asset or a loan. So once you have all your transactions in your software or in your spreadsheet, then you can move on to number 3 and categorize all your transactions. You'll need to label and categorize what transactions were expenses, which ones were revenue, and okay, what type of expense it was and where the revenue was from. Now, this becomes much easier with a software like QuickBooks, because once you categorize a specific vendor, you won't have to do it again because the system will remember it. The fourth thing to check off is number 4, keep receipts. So right after you log and categorize all your expenses, then you are practically done with the receipt. However, you still may need to keep it in case you run into an IRS audit. Now, IRS receipt requirements can get a little bit tricky, and some people think you need to keep every single receipt. But look, this is not the case. In fact, I have an entire video where I break down the IRS receipt requirements, which I'll link at the end of this video so you can watch it right after you finish this one. The fifth thing on my checklist is number 5, reconcile your bank accounts. Now this part is critical because if you fail to reconcile your bank accounts, then you'll likely end up with some errors in your bookkeeping. Okay, reconciling is the process of making sure your beginning balances and your ending balances on your books match up with your banks. Now, I'm gonna be honest, depending on your business and your transaction types, this may get a little bit tricky, and you'll likely have to do some research on how to handle recs within your type of company or your industry. But you can also make sure you are subscribed to our channel, because we'll likely have more videos breaking down bank reconciliations in the near future. Okay, moving on to number 6, I have pay your vendors and other bills. just go ahead and get it over with. If you have some invoices that you know you need to pay, or you have some business credit card bills, then this is your reminder to make the payment, okay? Have that on your checklist and make sure you check it off. The last thing you want to do is forget to make your payments, because that could affect your business credit score and harm the relationship you have with any of your critical vendors or partners. Okay, so those are some of the tasks you want to make sure you are handling monthly. Now, once your books are done, then you should be able to move on to number 4 and prepare and analyze your financial statements. Now, this is where accounting starts to become your best friend. So again, with most bookkeeping software like Quickbooks, once you have entered all your transactions and categorized them, then you should be easily able to create a financial statement. The big ones that most startups use is to analyze their profit and loss, or also known as an income statement. This statement basically summarizes all your revenues and all your expenses to determine your overall profitability. Now, there are 2 big financial metrics that you're going to fall in love with. Okay, the first one is called runway. So this is basically going to tell you how much cash you have on hand versus how much money you spend. For example, if you have $100,000 in the bank, but you are spending $10,000 each month, that means you have a 10-month runway before you need to make $1 in revenue. Knowing your runway will give you a clear understanding if your business is trending in the wrong or right direction, which gives you an opportunity to make some changes before it's too late. Okay, the second metric is called your net profit margin ratio. This number will tell you how much profit you earn for every dollar of revenue. For example, if you have $10,000 in revenue and you have overall cost of $8,000, then your net profit margin would be 20%. And once you know your net profit margin ratio, then you can start answering questions like, okay, is this a typical profit margin ratio in your industry? Is this aligned with your older financial projections? And what could be done to improve some of these profit margins, and so on. Now, before I start any business, I take a strong look at the industry profit margins, and if there is something unique that I could do to improve those margins, like introduce a system that I built or a new technology that the industry may not be accustomed to. So runway and net profit margin are the big 2, but analyzing your financials could help you identify other things like who are your biggest customers, or who are your most important vendors, and what are you spending the most money on? Is it worth it? And so on. And those are very important to know. Now, let's move on to number 5 and quickly answer the question, should you do your bookkeeping and accounting yourself or outsource it? Now look, I'm an accountant and my company offers accounting and bookkeeping services. And I'm gonna keep it real with you, okay? The decision to handle your own accounting and your bookkeeping and your taxes comes down to 3 things: time, money, and knowledge. And these are 3 things that only you would know. So when it comes to time, okay, are you willing to spend 4, 5, 6 hours to do your own bookkeeping? If so, then maybe you can learn how to do it yourself. On the other hand, if you are willing to pay someone $300, $400, or $500 a month to do the bookkeeping for you while you focus on your business, then maybe outsourcing is a better fit. And finally, you want to think about the knowledge. Okay, if you know you are horrible with numbers or you hate details, then you probably shouldn't go through the hassle of learning something that you'll likely hate. But if you have a technical side and you understand numbers and you like looking at money, then not only could you do it, hey, you may actually enjoy it. All right, so I'm on my computer now, and as you can see, I am on QuickBooks.com. QuickBooks is the software that I recommend for all my US-based small business clients because it has virtually everything you need in order to manage your own bookkeeping and accounting. So let's talk about how to set up an account. First, let's look at our plans and pricing. As you can see right now, they have 50% off the first 3 months. So there are 4 plans to choose from: Simple Start, Essentials, Plus, and Advanced. All of the plans have income and expense tracking, bookkeeping automation, invoicing and payments, receipt capture, cash flow management, and a lot more features, as you can see. Now, for most of my small business clients, starting with just the simple start is absolutely fine. Sometimes my clients may need an essentials account if they have a bigger team or they have partners, because with the essentials account, you're able to add more users. So if you have partners or a bookkeeper or just anyone else on your team that is maybe handling invoices or accounts receivables and account payables, then you would want the essentials plan. The plus and advanced plans aren't really necessary for your average small business. Next, you have the option to add payroll. Now, if you're paying yourself a W-2 salary or you have W-2 employees, then you're gonna want the payroll features. Now, there are 3 plans to choose from here. I like the Payroll Elite because QuickBooks will basically handle all your payroll functions. And if QuickBooks makes a mistake, which sometimes they do, there's this tax penalty protection, which means they'll pay and cover any estimated tax penalties or any state payroll tax penalties that they did not make on time on your behalf. So that is something that I loved. As you can see, they cover up to $25,000 in potential penalties if they make a mistake. So I like the Payroll Elite plan. From there, as you can see, your monthly bill is about $104 a month. And from there, you would sign up and you'll have your first bookkeeping and accounting system ready to go. Now, remember, your bill may be a little bit lower if you don't need payroll, but if you have W-2 employees or if you do pay yourself a reasonable salary as an S corporation, you're going to want to have the payroll account. All right, now let's talk about how to set up once you have an account. Oh yeah, one other thing I want to show you, if you are an accountant or you're looking to start up your own bookkeeping business, then you're going to want to sign up as an accountant or a firm user on QuickBooks Online, because that's going to allow you to manage your own clients from one account. And when you do that, it looks something like this. So this is my firm account, and then I'll have different sub accounts that I can switch to with my bookkeeping firm. So hopefully that makes sense. Now let's move into an individual account. All right, now once you have an account, you're gonna log into your dashboard first. Now, depending on what you have set up and what's going on, your dashboard may look a little different. As a new account owner, you're likely gonna see some setup instructions, but here I have a sample company showing, which shows some different tasks that are overdue and so on. Typically, when I log into a QuickBooks account, it's gonna highlight some of the bank accounts I have already connected, along with maybe some cash flow statements of cash in and out. All right, now when you log into your account, the first thing I want you to do is go to Transactions and set up your chart of accounts. Okay, your chart of accounts are like your structure for all your financial transactions, okay? This is where you're gonna set up what is gonna be an asset, what is gonna be a liability, what is an expense, what is considered income, and so on. So these are basically all your accounting categories. Now, this is a landscaping company, so you'll see some things that are relevant for landscaping companies. Of course, again, we have all our fixed assets, which we have trucks. Then we also have our credit card accounts. Then we have our account payable or liability accounts, equity accounts, and then our income accounts. So again, as a landscaping company, you might have landscaping services, job materials, labor, so on, okay? And then of course, you're gonna have your typical accounting expenses, advertising, automobile expenses, bank charges, commissions, fees, and so on. Now, one thing I love about QuickBooks is that your account is going to come preloaded with a lot of your chart accounts already explained for typical accounting and bookkeeping expenses for a small business. So you don't have to worry about completing this as in depth as you see here. But if you know you have, like, let's say a marketing agency and you're going to have marketing agency income, then instead of saying landscaping services, of course, you'll say like client services or something of that nature. So step 1 is go through your chart of accounts and go ahead and add any particular accounts that you need to add by clicking this add button, giving an account name, and then selecting a particular category for that chart of account. Now, once you have your chart of accounts set up, which by the way, you can always go back and add more later, then the next step is going to be connecting your business bank accounts. To connect a business bank account, you're going to head over to Bank Transactions. Now, since this is a simple account, I've already connected a credit card account, a savings account, and a checking account. However, if you are trying to connect a new account as a new user, then you would click on this link account. And from here, it's going to allow you to link your business bank account online. So you would search for your business bank account and follow the instructions. Now, it's important to note that it is relevant to have a business bank account. Sometimes QuickBooks does not connect with personal accounts. So if you don't have a business bank account, then you may have to find another means to get your transactions loaded in here, which means that you can come here and click upload a file, which would typically be a CSV file of your bank statements, of course, manage connections or order particular checks. All right, now once you have your business bank account connected, then you're able to see the transactions associated with your business bank account. It looks just like it would on your online bank account. It shows you the date, a description of the transaction, and it tries to go ahead and categorize what the expense may be, along with how much you spent or how much you received. All right, and so it does this for all of your accounts, your checking, your savings, as well as your credit card account. Now, this is important because this is where the bookkeeping really starts, okay? Now that you have your chart of accounts and now that you have your bank accounts connected, you can start to actually do bookkeeping. And what is bookkeeping? We're gonna start categorizing transactions. So if I click on Bob's Burger, I have the ability to match the transaction, record it as a transfer, or categorize it. And that's what I'm gonna select is categorize it. And then I have the ability to categorize this. So right now it's uncategorized, but let's assume Bob's Burger was meals and expenses. It wasn't a product or service. I can add a memo if I would like to, but for the most part, I'll just click add. And then boom, if I go over to categorize, I can see I have now categorized this particular expense. And what that means is it's gonna show up on my financial statements, okay? We'll get to that later, but this expense is now gonna show up on my profit and loss statement as an expense. And I could also, if it was an asset or a liability and I categorize it, it would show up, of course, on the balance sheet. All right, so as a business owner, what you're gonna do is go through and just start categorizing all these transactions, right? And so for Amazon, since this is a landscaping company, let's just say maybe this was some job supplies. So I'll search supplies and add that as an expense. If I knew what this vendor was, I would add the vendor here, but for the most part, I can click add and move on. So your first task is going ahead and just categorizing all these transactions. Now, as you begin categorizing transactions, QuickBooks starts to get smart and allows you to automate a lot, right? So if I go down here, I can see Norton Lumber and, all right, and QuickBooks have already determined that this might be lumber and building materials associated with a particular credit card account. All right, and so QuickBooks starts to try to match your particular transactions based on what it sees. All right, so I would come here again, this would likely be like job supplies. So we'll just go ahead and put in supplies and add that here. It's also important to note that you can add receipts to particular transactions. So if I were to go to categorize, I can go ahead and attach a statement, which would be a receipt. Now, I wanna show you where this gets cool. We can create a rule. What rules means is you can actually have the system automatically categorize things for you. So if I click a rule, I can name it. Let's say this is a car wash automobile expense. I can always categorize this particular expense as an automobile expense. So that way, instead of me having to go through every single time for those transactions, it's gonna automatically categorize any of those transactions. So as you can see, it now categorized both of these squeaky clean car expenses as a automobile expense. All right, and so the power of setting up rules is if you are a business owner and you have the same transactions over and over again, which typically we do, you can set up these rules so that your bookkeeping starts to become automated. And this is what I like to teach small business owners, because when you go to a bookkeeper or an accounting firm, typically that's what they're gonna do. They're gonna set up these rules that happen again and again and again, and you may think they're working hard doing your bookkeeping every month, but really the system is doing all the bookkeeping for them, and they just come to you and report the financial statements. All right, so if you are an accountant or you are a small business owner and you're tech savvy and you're number savvy, then setting up rules will allow you to automate a lot. All right, now once you have started to categorize transactions, the next step you're gonna wanna do is actually look at your sales receipts and invoices. All right, now that you have categorized all your expenses in the bank feed, the next thing you're gonna wanna do is make sure you handle any of your sales or your accounts receivables. So QuickBooks has a sales tab, and here you're able to do a whole lot, right? You can set up customers, set up different products and services. You can provide estimates for clients. You can send invoices, recurring invoices to clients. You can send sales receipts and a lot more. Okay, so if you're someone who likes to send invoices or you like to have things on accounts receivables, then you'll use the sales tab in order to get that set up. Additionally, you may have, let's say, bills. Okay, so maybe you work with a particular vendor and you want to do some accounts payable. So you will have the vendor send you an invoice, you'll enter your invoice in manually, you'll share whether or not the invoice has been paid or not. And so if you are trying to kind of manage your cash flow and you want to pay bills at a particular time, here is where you can add the bills and get that set up. All right, now from here, what you'll want to do is once you categorize all your transactions, you've taken care of all your sales receipts, you're taking care of all your bills, then it's time to do what is called reconciliations. Okay, now your reconciliations is basically when you're matching your books, your accounting books, which is what we're doing here, with your bank statements. Okay, so whatever your bank statements beginning and ending balances are, you want that to match up with your beginning and ending balances on your bookkeeping as well. That makes sure that everything was completed and aligns perfectly. All right, so to get started with a reconciliation, of course, you would click on Get Started. And then from here, you can kind of look at some of the prompts that walk you through what this is and how to do it. But again, what we're going to do is we want to match up the beginning balance with the ending balance. So we would take your bank account statement and we would put in whatever the ending balance is. In this case, let's just say it was 5,000. We'll enter in the ending statement date. Let me go back in the past and then hit Start Reconciliations. Okay. And now, of course, this isn't going to be exactly right, but at the end of the day, what you want to see is that the balance and the difference is zero, right? So we want our book balance and our bank account balance to be reconciled exactly right, which means that it all equals to zero. Now, if something is out of place, that's when you want to come in and be like, oh, I accidentally maybe put in $86 instead of $87. And so you would come in and actually correct this particular transaction so that it aligns with your bank account. All right, let me bring the camera back on me for a second and drop a truth bomb on you. Okay, reconciliations can be extremely easy if you are a small business owner and you just have one, maybe two business bank accounts, then absolutely you can handle this yourself. Now, if you are a small business owner and you have 3, 4, 5, 6 different accounts and you have different, let's say, transactions happening outside of your business account, like maybe you're getting a loan, maybe you're getting a mortgage, you're acquiring different assets, that's where reconciliations can really be troublesome. And so that is where you really get the value of hiring a bookkeeper or an accountant to do your own books for you, because these experts can go in and absolutely handle it without you having to spend all your time as a small business owner trying to figure it out. So I just wanted to drop that truth bomb on you. Let's get back into the reconciliations here. So again, what you're looking for is that everything balances to zero. That ensures that your bookkeeping is absolutely correct and up to date. And you're going to want to make sure your reconciliations are complete for the entire year. So that means each month is reconciled for each account. And then once it's reconciled completely, then you're able to generate financial statements like your profit and loss and your balance sheet for your actual tax preparation or tax planning needs. From there, what you can do to see your reports is go to this report tab and click on standard reports. Now, there are a ton of different financial reports that you can pull from, but for the most part, you're going to rely on the profit and loss statement for your financial income tracking. This is going to show you all your income that you tracked, as well as all your expenses, and ultimately get down and show you what your net income or net profit was. And then same thing for your balance sheet. If we go over here, we can see all of our assets and liabilities entered in. So our bank account statuses, our account receivables, our assets, our liabilities. And at the end of the day, your total liabilities and equity should equal your total assets. Okay, that's the accounting equation. Assets equal liabilities plus owner's equity. Now, the last thing I want to show you are going to be the payroll features, because most small business owners are going to have contractors and people that they outsource to. So you can click on payroll and contractors. And in my sample account, I already have a contractor set up. But if I wanted to add a contractor, I would hit add contractor, put in contractor's name and contractor's email address, and then click add contractor. And what's going to happen is it is going to email the contractor to complete their profile. Now, what does that mean? It's going to send the contractor to a W-9, which looks like this. Let's go ahead and pull up a W-9 form. It's going to pull up a W-9, which looks like this, okay? And it's going to request the contractor's name or entity, what the contractor is, their address, their city, as well as their identification number. And then it's going to have them sign to confirm they are a contractor for you. And at the same time, if you do direct deposit, it's going to ask for their bank account information so that you can send this contractor a direct deposit. Once you do that, you'll see the contractor listed here, and then you're able to click on their last payment or even pay the contractor a new payment, whether it's a paper check or a direct deposit. Okay. Now, if you are an S corporation, then you must be paying yourself a reasonable W-2 salary, or if you have employees that work for you, you tell them what to do, when to do it, how to do it, then you need to pay them a W-2 wage as well. Now, I can't show you what that looks like in my sample account, so let me switch over to one of my real live bookkeeping accounts. All right, now I am in one of my live bookkeeping accounts for one of my businesses. So of course, these are real people and I'm gonna have to blur out some of the names, but I wanted to show you what this actually looks like. So right now I'm in the payroll employees section, which is where you will see all your W-2 employees. You'll see their names, their pay rate, their pay method, and their status, whether or not they're an active employee, or you can switch to the inactive employees as well. Over here on the top right, you can see I have the option to run payroll now. You'll also see when the next payroll date is. If I wanted to send a bonus or commission only payment, I can do that here. Now, when you're setting this up as an S corporation paying yourself, or for a W-2 employee you just hired, you would click on add employee, and then of course put in the employee's name, their email, and the hire date, because that's going to determine the pay period they fall into. And then from there, you have the ability to let the employee onboard themselves, which would allow the system to send out the respective tax forms, allow them to set up the direct deposit information, and some other details. I typically allow my employees to self-onboard themselves. And then other features inside of QuickBooks are time tracking features. So if you want to see what your employees are working on, you can do that here. Or if you want to track the expenses that they may have, you can do that as well. After that, you can add employee, and then you would see them listed as a pending employee. And once they fill out the information, you'll see their status turn to active. All right, so that covers the basics of the payroll features inside of QuickBooks. Now, of course, this only applies to people who have team members or people who are an S Corp and must pay themselves a reasonable salary, as well as if you have W-2 employees. And again, I recommend the payroll plan and just getting the highest version so that QuickBooks takes care of all the payroll for you and you don't have to worry about any penalties that you may face with the state, because there are state tax obligations as well as federal tax obligations associated with payroll taxes. All right, let's go ahead and dive in with number one, the types of small business taxes. So remember, as an entrepreneur, you are responsible for paying your taxes now. So then of course, it makes sense to know which taxes you need to pay and which taxes you don't need to pay. Now, almost all taxes can be divided into three buckets, okay? Taxes on income you earn, taxes on what you buy, and taxes on what you own. Let's start off by first talking about the type of taxes you pay on money that you earn, because these are your biggest taxes, and as soon as you make some money, Uncle Sam is gonna be looking for their cut since you made it on US turf, so to speak. All right, now up first is the individual income tax. This is the one that most people should be familiar with. It's where your tax rate increases as your income increases, because here in the US we have what is called a progressive tax system. And so every year the IRS releases new tax brackets, which I'll put up on the screen right now for 2022. Now, as a business owner, you are still subject to these tax brackets and tax rates if you have a pass-through business entity like an LLC, S Corp, or simply a sole proprietorship. So it is very important that you understand where your income may fall, as it helps you to predict your tax liability. Now, if you want a deeper explanation on this, then I highly recommend you watch my video on taxes for beginners, where I break down the progressive tax system with examples and much more detail than I will in this video. Also, I'm going to break down how to pay these taxes as a small business owner in the next point, but for now, let me keep going through the different types. Okay, the next common business tax is the corporate income tax. The only type of business entity that is not subject to individual income taxes are C corporations. And that's because C corporations pay a flat federal tax rate currently set at 21% for 2022, and pay a flat state corporate tax rate, which depends on the state that you do business in. Now, before you start thinking, well, okay, I want a C corporation. Hold on. here's a quick pro tip. Okay, C corporations are subject to double taxation because the profits that are taxed must remain in the C corporation. And so if you as the business owner decide that you want to pay yourself, then you still could be subject to other tax rates. So C corps can be a bit tricky and something you should definitely consider talking to a tax advisor about, which by the way, if you need help with tax planning or tax preparation, we may be able to help. Okay, so now that you know about income tax and corporate tax, let's talk about another popular tax for business owners, payroll taxes. So if you have any employees, you must report and deposit federal income tax withholdings, Social Security and Medicare taxes where you pay half and your employee pays half, and federal unemployment taxes. And sometimes people ask me, Sean, should I look for a W-2 employee or a 1099 contractor? And of course, number one, always do what's best for your business. But as you can see, you can actually end up paying more taxes when you hire W-2 employees because some of the tax payments fall on you as the business. Now, I'm not suggesting that means you shouldn't hire employees because there are a lot of fantastic benefits of having someone who is solely dedicated to your business, but that's just the tax consequence of it. Now, closely following payroll taxes, you have self-employment taxes. This tax is specifically for those who are taxed as LLC owners, general partnerships, and sole proprietors. This is where the IRS is basically telling you, hey, since you don't have an employer who is paying your share of Social Security and Medicare taxes, then you need to pay both of them. Because once again, when you are employed, you typically will pay half of your Social Security tax, which is 6.2%, and half of your Medicare tax, which is 1.45%. But now you need to handle all of it, which brings the self-employment tax rate to 15.3%. Now, here's another pro tip. Once you start to make enough income, it could make sense to elect to be taxed as an S corporation because S corps don't pay self-employment taxes on their distributions. However, becoming an S corporation can be expensive and require more from a business owner, which is why it makes sense to wait until you have a considerable amount of net profit. I would say at least $60,000 in net profit before you consider electing to become one. So those are some of the biggest taxes when you earn as a business owner. Now let's quickly talk about some taxes on things you buy. Now the two that I have don't apply to every business, so I won't go into much detail. All right, so first up you have sales tax. You've probably seen this before printed out at the bottom of your store receipt after you purchase a good or a service. Sales taxes are a tax on retail sales and typically something that the state wants to collect. Now if you own a retail business, the good news is this tax is passed off to the consumer and it's just something that your business is responsible for collecting. Okay, another type of buy tax is the excess tax. This is a niche type of tax that applies to certain types of goods like tobacco, alcohol, soda, gasoline, and so on. So if you're thinking about getting to that market, make sure you take note of the excess tax. All right, shifting gears to taxes on things that you own, of course you have property taxes. This tax is applied to immovable property like land and buildings in states with property taxes. And most people have a good handle on this, but it is something I have to mention if you're a business owner and you're thinking about purchasing some real estate for your company. Now, another type of owner tax is the tangible personal property tax, or TPP. This is a state tax that applies to property that can be moved or touched, like business equipment, machinery, inventory, furniture, and vehicles. So if you own a vehicle, then you've probably seen something like an ad valorem tax assessed when you renew your registration. Now, about 43 states currently have TPP. Okay, so those are the main taxes you may encounter as a small business owner depending on your business or entity. Now, let's move on to the second part of this video and talk about number 2, how to pay business income taxes. So there are only about 3 to 4 basic steps you need to follow. Step 1, figure out the taxes you need to pay, which I'll simplify. Step 2, calculate how much you need to pay. Step 3, pay your taxes. And then step 4, file your tax return. Simple. All right, so let's chart this out. Step 1, I'm going to go through the type of taxes subject to sole proprietorship, single member LLCs, partnership LLCs, S corporations, and C corporations. When it comes to individual income taxes, everyone pays it except for C corporations. With self-employment taxes, S corporations can avoid some of them, not all, but some, and corporations avoid them altogether. The next type of tax are payroll taxes, and this applies to every business that has W-2 employees and always applies to S corporations since owners must pay themselves a reasonable salary. And the corporate tax rate, of course, only applies to C corporations. And on the chart, I've listed what tax returns these taxes are reported on. For example, single member LLCs use 1040 individual tax return and attach Schedule C, whereas multi-member LLCs must file an information return called the US 1065 return and then report their income on US 1040 using a tax form called K-1s. All right, so that's step one. Figure out where you fall and what income taxes you need to pay. Once you have that, then you move on to step number two and calculate how much you need to pay. So here's the thing. Since you are no longer an employee, instead of you withholding taxes on every paycheck, now you're going to need to pay every quarter in what is known as a quarterly estimated tax payment, which can be calculated by simply taking the total taxes you owe plus the total self-employment taxes you owe, which gives you your total estimated taxes, and then divide that by 4 to figure out exactly what you need to pay every quarter. So if you need help getting to those numbers, then I would suggest simply Googling and finding an online calculator, or simply pay 110% of what you owed in the previous tax year to avoid any penalties. Now, I also will put up on the screen the quarterly estimated tax deadlines for 2023, and as you can see, you have roughly 15 days after the typical calendar quarter ends to pay your taxes. Now, it is important to note that you don't have to make quarterly tax payments, or you fail to do so on time, then you can get hit with what is called an estimated tax penalty, which is like the IRS's late fee, if you will. And this fee, along with others, can be avoided if you simply pay your taxes on time. Now, once you know how much tax you need to pay, then you can move on to step 3 and pay your taxes, which you can do by simply going to irs.gov/payments, log into your account, and select make a quarterly payment. From there, you can choose to use your bank account or any debit card, credit card, or digital wallet like PayPal to make your payment. And then finally, step 4 is to file your tax return, so you report all your income and all your payments to the IRS. All right, now let's move on to the third part of this video and talk about some of my favorite things, which is number 3, business tax deductions. Because business owners, in my opinion, have the best tax advantages. Because as long as you play it smart, you can significantly lower your tax bill, sometimes all the way down to 0, like the rich and wealthy, if you use the tax code to your advantage and take certain business tax deductions. A business tax deduction is an expense a business can claim in an effort to reduce their taxable income. And since there are many unique types of businesses, the IRS considers a business expense deductible as long as it is ordinary and necessary to the company. An ordinary expense is something common and accepted in your type of business, and a necessary expense is something that is helpful and appropriate for your business. So if you use your imagination, that can be a lot of things. But some tax write-offs are very common, like employee expenses, the cost of hiring, wages, benefits, and even writing off taxes like payroll taxes, travel expenses, airfare, hotel stays, meals, office expenses, rent, utilities, supplies, advertising, equipment expenses, purchasing certain assets like machineries, vehicles, and even planes, just to name a few. And since businesses help stimulate the economy, many states offer specific business credits, which helps reduce business owners' tax liabilities dollar for dollar. Popular credits are the Research and Development Tax Credit, credits for hiring veterans and other employees, credits for developing your business in a certain zone, city, or county, and so on. We have a lot of videos on this channel that talk about tax write-offs and credits, so make sure you're subscribed if you haven't already. Let's go ahead and move on to the fourth part of this video and talk about number 4, staying compliant. Staying compliant with the Internal Revenue Service, the IRS, means following all applicable tax laws and fulfilling your tax obligations as a business owner. And listen, if you are not found compliant with the IRS, you could cause yourself a lot of unnecessary pain. For example, you may find yourself paying additional fees and penalties. You could find yourself getting and losing tax audits. You could lose your status as an LLC owner, which offers many legal liability protections. So how do you stay compliant? Here's 6 tips. Number 1, follow the rules of your LLC. LLCs are governed by state law, and each state has its own set of rules for LLCs, so make sure you understand them and you follow them, which may include some requirements like maintaining records, holding meetings, or electing members and managers. Number 2, keep accurate and organized records, aka bookkeeping. This will make it easier for you to stay compliant and helpful in the event if you're ever audited. Number 3, fulfill your tax obligations. This includes filing your tax returns, paying your taxes, and sending the appropriate tax forms when necessary. Number 4, follow employment laws. If you have employees, it is very important that you understand and you comply with employment laws, including laws related to minimum wage, overtime, and discrimination. Number 5, protect consumer privacy. If you collect personal information from your customers or clients, it's very important that you protect their privacy and you follow the applicable laws related to data and privacy protection. And then number 6, obtain any necessary licenses and permits. Depending on the nature of your business and the location of where you operate, you may need to obtain certain licenses and permits in order to legally conduct business. So make sure you understand what licenses and permits are required for you, and then make sure you take the necessary steps to obtain them and renew them. All right, so we covered a lot here, and if you understand all that, congratulations, you are now in good shape to understand and manage your business taxes. Let's talk about the IRS receipt requirement, because look, if you want to write off qualified expenses, then you're going to want some proof, right? Like, you're gonna want a definite and clear way to substantiate any tax deduction that you decide to take. And I get it, right? Because I used to be one of those people that thought you needed to keep up with every single tax receipt that you have with some type of giant file cabinet to meet the expectations of the IRS. You don't need to keep up with every little receipt. In fact, many IRS requirements aren't as strict as you might think. Let's go ahead and dive in with number 1, a quick walkthrough of tax deductions. Now, if you watch our channel a lot, then you're probably already super familiar with what tax deductions are. But I do think it's helpful to do a quick walkthrough so that you have proper context to how they work within the IRS receipt requirements. So of course, every year taxpayers must submit their total income from every source, which may include your W-2 wages, your self-employed business or your side hustle income, and any other forms of income. Now, once you report all your income, then you must submit your tax deductions, which helps to determine the amount of income you will actually pay taxes on. And this is also known as taxable income. So it's total income minus tax deductions equals taxable income. Okay, you know this. Now, the thing that gets most people in trouble is either A, they don't know what qualifies as a tax deduction, or B, they don't know how to substantiate a tax deduction or provide evidence. And this video is all about B. Now, for individual taxpayers, there isn't much effort required to substantiate tax deductions because, okay, look, you're likely going to be receiving some type of tax forms for predefined tax deductions, such as a 1099-B form for selling stocks and cryptos, or a mortgage interest statement, which reports the amount of interest you paid on a mortgage, or your retirement contributions, or you may have charitable donation receipts, and so on. However, businesses can write off almost anything. So being able to substantiate a tax deduction is more critical for them because they won't receive some tax forms for the expenses that they take, which brings me to number 2, how to substantiate a tax deduction. So in general, you need 3 things to substantiate a tax deduction. Number 1, you need the amount of the expense. Number 2, you need the time and the place for the expense. And number three, and this is important, you need a business purpose, which is usually ordinary and necessary. Now let's go ahead and review these requirements with a real IRS court case. So this guy named Wallace was an airline pilot who worked as a real estate broker, primarily dealing with commercial properties, and he claimed more than $14,000 in travel, meal, and entertainment business expenses. But the IRS took a look and they disallowed all the expenses. So Mr. Wallace appealed in the U.S. tax court, where he provided receipts for all his meals, his lodging, his transportation, and airfare. Well, he ended up losing the court case because he was never able to establish a believable business purpose for them. For example, he claimed travel and meal expenses for an 11-day trip to Hawaii, where the only business purpose was to scout potential properties for a client. Now, already, if I'm looking at this, then I'm thinking, hey, maybe a 1 to 3 day trip to scout properties may be more reasonable, but 11 days? Plus, if you're going to take an 11-day trip to Hawaii for business purposes, then you better have set up an agenda. Like, you better have tons of appointments booked before you leave. Like, what I would personally want is a full detailed log of all the locations that I'm visiting, how long I plan to be on each location, and why exactly I might be scouting that particular area. But instead, let's take a look at what Mr. Wallace actually did. So records show that Wallace paid for multiple hotel rooms for the same nights, and that there were multiple occupants in the rooms, which led the court to determine that the nature of his visit to Hawaii was more so to go on vacations with others than for specific business purposes. But then within 1 day of his return from Hawaii, he traveled to Lake Tahoe, where he booked a townhome, and that also did not qualify as a business trip. And that is why I tell people sometimes one small error or one small mistake can trigger an investigation into all your business operations and all your personal finance and respective tax deductions. Now, I want to be clear that Mr. Wallace did in fact have the proper receipts and documentation for his expenses. So that wasn't the problem, right? The problem wasn't the fact that he lacked documentation, but rather what he lacked was a business purpose. Okay, so hopefully that story makes how to substantiate a tax deduction crystal clear. Now let's move on to number 3 and talk about what receipts you need to keep for tax write-offs. Now, when we purchase things as business owners, we normally have 2 types of payment methods, right? Like, we're either paying with cash or a business debit or credit card. So let's talk about cash transactions first. The IRS receipt requirement for cash purchases is really simple, okay? If an expense is qualified, meaning it is ordinary and necessary as a business expense, then guess what? You actually don't need a receipt for cash transactions under $75 unless it's related to lodging, okay? This is also known as the Cohen rule. So that's great news, right? Like, you don't have to worry about keeping up with all of these small receipts and transactions that you use cash for. Instead, you only need to keep receipts where you spent more than $75 in cash. So if you took your clients and your partners out for a $300 lunch, then you better make sure you keep up with that receipt. And I'll share some tips on how you can do that in a second. But first, let's talk about what if you used a business debit or credit card. Well, it gets even easier from here because according to the IRS, supporting documents should accomplish the following, okay? It should identify the payee, it should show the amount paid, it should show proof of payment, the date it was incurred, a description of the item purchased, which means documents such as credit card statements and bank account statements or invoices all qualify as supporting documentation, which essentially means that you don't need to keep up with every single receipt if you are using a business debit or credit card for your expenses, which is awesome because most banks will keep digital statements for you, and the IRS is legally required to accept digital forms of proof for any of your tax deductions. So this means that you may be able to finally stop hoarding all your receipts. But if you still have a lot of cash transactions, or you're just not comfortable with the idea of letting go of your receipts yet, then you should at least feel comfortable knowing that you can take a picture of your receipt, upload it to your computer or some type of cloud storage, and that is enough to help you substantiate any tax write-off that you want to take. But remember, that just takes care of the documentation. So it still is important to note the business intent and the business purpose related to the expense, because remember, just because you have a receipt doesn't make your tax deduction substantiated. Now let's move on to number 4 and quickly talk about documenting income. Now, most people don't have a problem with documenting income, right? Because many merchants will send a 1099-K form showing how much income has been processed for you. By the way, Cash App, PayPal, Zelle are soon joining the list of merchants that will send you those 1099 forms. Anyway, merchants will send a 1099-K form, and for service-based companies, it's normal for your clients or your vendors to send you a 1099 NEC or a 1099 miscellaneous form. And in general, every entrepreneur loves to focus on how much revenues or how much sales they're making, so it shouldn't be too difficult to track income from your main sales platform or your register. Nonetheless, documenting income is still important if the IRS has questions about your income sources and making sure that you're reporting it correctly. Now, when it comes to all this documentation, let's talk about number 5. How long do you need to keep these records for? Well, according to the IRS, you need to keep records as long as needed to prove the income or deductions on a tax return. In general, that means you want to keep records or documents that support your income, your deductions, and your credits for a period of 3 years after you file your tax return or the tax deadline, whichever one is later. For example, if you file an individual tax return with a Schedule C on March 18th, 2022, you want to keep the records related to that return until April 15th, 2025, which is 3 years after the tax deadline for that 2022 return. However, it can be extended to up to 7 years in certain circumstances, such as claiming a bad debt deduction, or even indefinitely if you are found not compliant with filing your taxes at all. And remember, it is okay if you decide to keep all your records digitally. Hey Sean, look, I turned all my physical receipts into digital ones. Now, I'm not sure if the banks are required to hold your statements for 7 years, so just in case, it's a best practice to store all your digital documents on your computer or on some type of cloud storage, or both, so that it can be accessed for years to come. Okay, now let me share some helpful tips with you with number 6, how to manage and organize tax receipts. So here's my list of tips. Number 1, go paperless, okay? Use a business debit card, a business credit card for all your business transactions as proof of your business expenses. Number 2, download and store your bank statements. Number 3, use a digital receipt app so that you can store receipts for cash transactions over $75. You just whip out your phone and scan the receipt and then upload it to an app. Number 4, log the business purpose. Some people try to remember everything by memory, but what I like to do is keep some notes. Okay, one of the things I will do is I will write down the business purpose, the meeting notes, and so on before I digitize my receipts. Number 5, make sure you have proper bookkeeping combined with record keeping. So within bookkeeping softwares like Quickbooks, you can leave notes on certain transactions as well as attach receipts and spell out exactly what this receipt's business purpose was for. All right, next I'm gonna go through some small business tax write-offs that may apply to you or your clients. And I'm gonna do this in a fun way where I'm actually writing off everything I can in 24 hours. But first, let's go over the rules I must follow on my challenge of making everything a tax write-off for the next 24 hours. Okay, rule number 1, I cannot spend any money out of my pocket unless it is a tax write-off. Rule number 2, I cannot eat anything unless it is a tax write-off. And rule number 3, I can travel anywhere unless it is a tax write-off, and I've got some places to go. Now, tell me down in the comment section below if you think this challenge is too easy or too difficult, and if you've ever done anything like this before. So right now it's around 7 a.m. The sun is going up and I'm getting ready to get my day started. So let's get into today's challenge. Okay, before I get into my first tax write-off, it is very important to note that I can make this video and take a lot of these tax deductions because I am a business owner. And when you are a business owner, you have the power to write off almost anything. The 2 big rules that apply for for businesses are, number one, the expense must be ordinary and necessary for the business, meaning the expense is something that would naturally occur for someone in this line of work or in this industry. And then number two, the expense must be necessary in order for the business to progress or to operate. So if you are a business owner or if you are thinking about starting a business, then a lot of these tax write-offs from this video will also apply to you. All right, so let's go ahead and start with the first tax write-off. Now, usually I work from home in my second bedroom, which is my home office, where I host meetings, I jump on Zoom calls, build tax plans, and I do a lot of my virtual work. But today I'm working out of my second location because I have a meeting later on in this video with one of my partners to discuss some growth strategies. So I need to travel, bringing me to my first tax write-off that I'll be using, the vehicle tax deduction. Because here's the thing. Since my home office is my dedicated office and my primary location, then anytime I leave my home for business, which is what I'm doing today, I get to write off the mileage from my primary office to my secondary office using the standard mileage rate, which for 2024 is 67 cents per mile. So let's get going and see exactly how big my tax write-off is going to be. All right, so I just made it to my second location and I ended up driving a whopping 4.4 miles, which gives me a $2.94 tax deduction, which is that 4.4 miles driven multiplied by the standard mileage rate of 67 cents per mile. Now, keep in mind, I will get this tax deduction when I travel back from my secondary office to my primary office. And plus, this won't be the only place I drive for business throughout the year. So let's just say hypothetically, I drove 10 business miles per year for the rest of the year. Well, that would add up to giving me a $2,445 tax deduction, so it definitely adds up. Plus, my business travel is short and your business travel may be a lot more, which will give you a bigger tax deduction as well. Now, if you do decide that you want to do something similar and implement this same strategy for yourself, I want to leave you with a very important note. Your home office must be your primary office and it must be in a dedicated space inside your home, because otherwise, if you're just driving from your home office to a business location, then those are considered to be commuting miles and those are not tax deductible. Okay, now I'm here at my second office, which is a popular co-working space here in Atlanta, Georgia, and I pay about $500 a month to have access and rent this space out, which of course is another great tax write-off. And there are plenty of open areas, there are private areas, so it's really nice to use this space to meet with my clients or my team, network with other business owners, or sometimes just get outside of the house. Plus, they have coffee, they have snacks and fruit, which is something I am definitely taking advantage of today so that I can eat a small breakfast tax-free. Now, what's super nice about this tax deduction is I can expand it by renting out one of the office suites or even accelerate the expense by paying my membership fees annually. And with that, let's get to work. Okay, so I just finished setting up my workstation and it occurred to me that I have some more tax write-offs to share as well. Now, obviously the items that are necessary for you to operate your business are all tax deductible. So here I have my monitor, I have my laptop, I have my phone, which a percentage of my phone that I use for business can be written off. I have other accessories like my mouse, my work glasses, and so on. But I wanted to quickly highlight my MacBook because this is the new MacBook Pro with the M3 processing chip, and it was something that I bought as a year-end tax strategy. So I bought this around the last week of December because number one, I needed it. My other laptop was starting to deteriorate. And number two, and maybe more importantly, because I created a tax plan for myself, I knew exactly what my liability would be or what I would owe to IRS, and it was slightly higher than I wanted it to be, so I made this purchase in order to help. And because it is a qualified tax write-off, with the help of IRS code section 179, I'm able to deduct the entire cost of this computer in the year that it was placed in service and essentially own this tax-free. So when it comes to business and what you're doing, don't think just about what you can write off now, but also think about what can you write off at the year's end. All right, so now I'm sitting down with one of our amazing partners, Joel, and he's in charge of helping people get signed up and working with our team. After a few minutes of discussion, both Joel and I got hungry, so we decided to head out and get some lunch. Thankfully, we didn't have to travel very far because there are restaurants in nearby walking distance. So we just simply went downstairs, found a restaurant that we liked, ordered there, and then we grabbed a table to continue our business conversation. Now, since Joel and I are continuing to discuss business, we get to take advantage of what is called the business meal tax tax deduction, which basically works exactly like it sounds. Okay, if you are having a business conversation over breakfast, over lunch, over dinner, or any kind of meal, then you can write off between 50 to 100% of the cost associated with that meal. So let's talk about what type of meals determine the percentage that you're able to write off. So meals that fall under the 50% category will be stuff like business meals with your partners and your clients, food for a board meeting, or even dinner provided for employees who are working late. While meals that fall under the 100% category would be stuff like a company-wide party, meal and entertainment included as W-2 compensation to your employees, or food and drinks provided for events. However, it is very important to note that the meal cannot be lavish or extravagant. Now, while the IRS does not specifically give us an amount of what would be considered lavish or extravagant, this is where you as the business owner have to use good judgment. For example, I wouldn't be spending $1,000 for an extravagant dinner just to discuss our calendars and our schedules for the next week. That sounds a bit lavish and extravagant, at least in my opinion. On the other hand, if we were trying to win over a client and the deal size was about $1 million, then maybe taking that client out for a $1,000 dinner could be justified. All right, so for this tax write-off, we're able to deduct 50% of our total meal costs, and the check came in to be about $50.77, which gives us our deduction. And if we were able to do this 20 to 30 times per year, then that would give us an estimated $1,500 tax deduction for our meals. Now, meals and everything else really should always be substantiated with proper documentation and proper record keeping. For meals, what I like to do is write on the receipt exactly what was discussed, take a picture of it, and then upload it into the cloud. And that way I always have documentation of exactly what was discussed, and because the date and the time is printed, I have exactly when this business conversation took place as well. So that's a pro tip on how you can use your business and write off meals as a tax deduction. After the lunch meeting, we both went back to the co-working space where we got some important tasks done before wrapping up the workday. Then I packed up my things and had plans to go work out so I could show you all this loophole I'm using to write off my gym memberships in a super cool way. Now the time is around 6:30, and look, I'm someone who believes that health is wealth. So I try to work out at least 3 to 4 times per week, and today is one of those days. Now, gym memberships cost money, and generally they are not tax deductible. So going to the gym for this challenge could be a rule break, but remember that co-working space I was working in earlier? Well, one of the major benefits of being a member of that space is that you get access to this state-of-the-art gym that has all the equipment that I could ever need with a full schedule of fitness classes as well. So now I get to work out and make gains tax-free. Plus there's a sauna, jacuzzi, pool, and everything is great. Now this is one of my favorite hacks for tax write-offs, and I usually don't make videos like this, so if you enjoy it, please tell me down in the comment section below and subscribe for more. Also, it is very important to note that gym memberships are very difficult to use as a tax write-off in many other scenarios. Even if you're working out with a client or you're discussing business with a partner, this is all still considered to be personal expenses. The only exception to this rule is if you are a professional trainer or a professional athlete, and it is critical for your career or your business to be in shape, such as an actor getting ready to be in a movie. All right, so workout complete. The time is about 8:30 and it's dinner time. And you may have been wondering, how am I gonna write off my dinner tax-free? Well, remember that business meal that I had earlier? Well, thankfully I have some leftovers, enough leftovers to help me squeeze out the rest of this challenge. Then I'm gonna hop into my car, right off the drive back home, and then share some of my final thoughts. But speaking of the car, I should mention that there are 2 ways to write off a vehicle. The method that I talked about at the beginning of this video is called the standard mileage method, but I could have also used the actual expense method, which would have allowed me to write off stuff like my gas or charging expenses, my repairs and maintenance, my car washes, and a big one, depreciation. And depreciation can be accelerated to present a massive year 1 tax deduction. All right, so now I'm gonna eat my dinner, head home, and then share some of my final thoughts around this challenge. All right, it's been another successful day here in tax-free paradise, and I'm at home now getting ready to call it a day. But really quick, the key takeaway I want to leave you with is sometimes the best tax write-offs, the best tax deductions are reserved for entrepreneurs and investors. And that is why I always encourage people to pursue your business interests, because if you are in the higher end of the tax bracket, then depending on the state that you live in, your tax rate could go all the way up to 50%, which means when you're purchasing products or services for your business, it's almost like you're getting a 50% discount, and then tie that into your lifestyle and you could be living a tax-free life. Because when you have a business and what you're doing is ordinary and necessary for the business, then you can write off almost anything. Just make sure you don't write off your wife.
Sean, where have you been?
All right, coming up next, my wife, who is a CPA, is actually going to go through some important financial statements like the profit and loss and balance sheet with you, because those are important to understand when it comes to bookkeeping.
I need you to take in every bit of these statistics that I am about to show you. So, according to data from the U.S. Bureau of Labor Statistics, roughly 20% of small businesses fail within the first year. 50% go out of business at the end of their 5th year. And 33% make it to 10 years or longer. That's 70% of business failure. But you achieve more business success and wealth by understanding a balance sheet versus an income statement. So I need you to click the like button and subscribe if you want to learn about these two critical financial statements for business. And as a special treat, I'll be going over the third critical financial statement. So stay tuned. Let's jump right in. So first off, let's talk about what a balance sheet and an income statement is and the difference between the two. A balance sheet is a financial statement that presents a business asset, liabilities, and equity at a specific point in time, such as the time of reporting. To dumb this down, it shows you the value of your company at the time of reporting. It does not represent the longevity of a business, but is simply a snapshot of the health of your company for a short period of time. This is usually used to plan budgets and/or to predict revenue for the following year. Also, the balance sheet helps derive evaluation ratios such as debt to asset ratio, which basically shows you the percentage of assets financed with debt. In other words, it shows if your business has enough funding to meet its debt obligations. The lower the percentage, the better, because it shows that you have an excessive amount of assets to cover your debt. On the other hand, an income statement is a financial statement that shows revenues and expenses at a given time period, such as the quarter or year. Essentially, this statement shows whether you are making money, a profit, or losing money, a loss. This is why you may hear people use the term profit and loss statement interchangeably with the term income statement. In addition, an income statement helps derive ratios such as a profit margin. This ratio shows the profitability of your business after all of the expenses are subtracted out. Now that you know what a balance sheet and an income statement is and the difference between the two, wait, world stop. Hi, my name is Sierra Stanberry, a corporate accountant at a Fortune 500 company and the wife of Sean at LYFE Accounting, the accounting company that saves people from high taxes and low profits. Carry on. Okay, so let's hop into why these are the most critical for operating a business. The balance sheet is critical because if your liabilities outweigh your assets, your business has no present value. It means you owe more money than you have. Let's say you have $60K in assets, which consist of your cash, inventory, etc., and $70K in liabilities, which consist of money you owe to your suppliers or maybe even the bank. In this particular situation, you are owing more money than you actually have. Seeing this will help you make better decisions within your company, such as not getting any more debts or taking on more risks than what's needed. Come on, how can anyone visually know this if they don't have a balance sheet? You can't. Too much debt may harm your ability to make more cash. So make sure you are reviewing your budgets frequently to see if you can cut back elsewhere to avoid getting debt. Also, keep in mind, just because you have a negative balance sheet does not mean your business is doomed. For example, let's say you're a real estate investor. The down payment initially is considered an asset in the form of equity. But also, you have a liability to pay on that property, which will show negative equity on the balance sheet. However, the income you are receiving for that rental property is increasing your net income, which in turn gives you the profit to take care of that liability. All right, so why is an income statement critical for your business? It's simple. No one wants to lose money. As mentioned before, the income statement shows whether you are making a profit or a loss. Let's say you have a business, your sales revenue is at an all-time high of $50K. You take out the amount of money you spent on your product, which is roughly $10K. This gives you a gross profit of $40K. You follow me? Good. Now, please do not mistake this as your number that coincides with the total profit of your business. It's called gross. Let's continue with this example. Okay, so you have a gross profit of $40K. Let's say your total expenses were $60K. This leaves your net income at negative $20K. Wow, Wasby, do you understand what's happening here? You have a gross profit of $40K and your expenses are $60K, which gives you a loss of $20K. You must exclude expenses from your gross profit in order to get the bottom line number, which is also known as your net income. This, my friend, is what you should pay attention to when looking at your income statement. Now, if you have a startup company, you just may see a negative net income because you are intentionally investing for the future. However, if this is an established business, then having a negative profit may not be good. All right, so how do you utilize the income statement in order to get your business profitable? It's actually pretty simple. Adjust your expenses. For example, you could adjust your rent expense. Maybe you need to run your business remotely to completely remove your rent expense. Overall, just remember to review your expenses to see where you can cut costs. So earlier I mentioned I would give you guys a special treat by going over the third most critical statement for small businesses. So here we go. The third most critical financial statement for small business is a statement of cash flow. So what is a statement of cash flow and why is it important? A cash flow is a financial statement that shows the cash position of the company, or in other words, how much cash is entering or leaving your company. A business must have enough cash to be successful. A business needs cash to pay its expenses, bank loans, taxes, etc. You get the point. And guess what? This financial statement tells you if you have enough cash to cover all of these things on a monthly basis. Have you ever heard of the saying, what you don't know won't hurt? Okay, well, let's not apply this to your business. Otherwise, your business may fail.
Today, I'm gonna take a deep look at how to read and analyze your balance sheet as an entrepreneur, especially if you are not in a position where you can hire a CFO yet. Because look, the balance sheet can be extremely helpful in showing you the financial position of your company, which can then help you to manage your overall business risks and decide which strategic moves to make next. So in this video, I wanted to show you how to read and analyze a balance sheet simply and easily, okay? I'll take a look at the basics of a balance sheet, how to create one and then analyze it. And then lastly, we'll review important metrics so you understand how you can use your balance sheet to make key business decisions. And of course, I'll have plenty examples and calculations along the way. But listen, if you are a beginner to balance sheets, then you'll definitely want to watch this entire video so that you completely understand everything. All right, let's go ahead and dive in with number one. What is a balance sheet? So the balance sheet is super important and can be a great tool that you can use to achieve more business and investing success. Now, there are many different ways to describe what a balance sheet is, but to me, it's exactly what it sounds like, okay? It is a sheet or a statement that shows you the financial balances within a business. This balancing equation is also known as the accounting equation, which is assets equals liabilities plus owner's equity. So assets are what the business owns, and liabilities plus owner's equity is what the business owes. Now, obviously, liabilities can be business debt from third parties, and owner's equity is also something the business owes just to the owners of the company. Okay, now to easily walk through this video, we're gonna create a fake example of a balance sheet, and we're gonna name this company in the balance sheet Sean's Famous Products, which is very important to note because at the top of a balance sheet, you're gonna have the company's name and the specific date when the balance sheet was generated. So for this example, we'll say that the specific date was March 1st, 2022, which will show you all the assets, liabilities, and equity at that point in time. Now, this is very different from an income statement, which shows you the data from a period of time, which could be something like March 1st to March 30th of 2022. Okay, let's go ahead and look at number 2, assets. So typically the first item that you're going to see on a balance sheet are the assets. The accounting definition of an asset is a resource with economic value that a person, company, or country owns and controls with an expectation that it will provide a future benefit. And as an entrepreneur, you will definitely need assets. Now, there are generally 2 types of assets that are reported on the balance sheet. You have current assets and then you have long-term assets. So current assets are basically assets that can be liquidated and converted into cash within 12 months. So let's continue to fill out our example balance sheet. Let's say that we have current assets of $50,000 cash or cash equivalents because of course that is liquid. Then we could have accounts receivable of $100,000. Now, accounts receivable is money that you expect to have in the near future. For example, if you have delivered a service and you have sent out an invoice that is waiting to be paid, then that would be considered to be an account receivable because you're likely going to be able to convert that into cash within the next 12 months. Next, you could have inventory worth $75,000. And of course, we could expect that inventory to be sold within the next 12 months. So those are some examples of current assets, which in this case would be a total of $225,000. Next, you have other assets or long-term assets. And we'll put this under property, plant, and equipment for $100,000 because long-term assets are considered to be investments towards the future growth of your company. So they're not something that you would be able to convert into cash within 12 months. An example of a long-term asset could be a critical piece of equipment to manufacture your product, or if you decide to purchase a property for your operations. So that would bring Sean's Famous Products total assets to be $325,000. Now stick with me because at the end, you're gonna see exactly how knowing your total assets can help you make some key business decisions. But for now, let's move on to number 3, liabilities. So as I mentioned, liabilities are obligations that a company owes other third parties. And just like before, you have current liabilities and you have other liabilities or long-term liabilities. So current liabilities are going to be obligations that you expect to pay back within 12 months. One example of a current liability that we can use in our example balance sheet will be accounts payable of, let's say, $100,000. Account payables are the complete opposite of accounts receivables, right? Like these could be invoices that your company needs to pay within 12 months or usually within 3 months. Then you could have accrued expenses of, let's say, $25,000. So these will be expenses that you know you have, but it hasn't quite yet been accounted for yet. Like maybe the invoice haven't been received, but you know the expense is coming. And accrued expenses are based on the accrual principle, which basically states that you must accrue for invoices that have not been received. Another example of current liabilities a company could have would be deferred revenue, and let's put that under $50,000. You can think of deferred revenue as prepayments from a customer where services and goods have not been delivered yet. And we would record it as a liability because this is an obligation for the company. Like, the company must deliver for it to make good on that particular debt or obligation. So this would bring the total company's current liabilities to $175,000. Then, as I mentioned, next you have other liabilities or long-term liabilities. And for this example, let's say that we financed our operations and we have long-term debt of $90,000, which brings our total liabilities to $265,000. Okay, let's quickly look at number 4, owner's equity. So once you know your total assets and your total liabilities, then what you have left over is owner's equity. So basically you would take the $325,000 in assets and subtract it by that $265,000 in liabilities to get the owner's equity, which is $60,000. And this is what the owners can claim as equity, or in other words, what will be left over if that owner decided to sell all their assets and pay all their liabilities. Now, here's a very important note, okay? If you have completed your balance sheet and your assets do not equal your liabilities and owner's equity, then you're looking at a balance sheet with an error in it. So something is off, and before you even think about analyzing your balance sheet, you want to make sure that you correct any potential mistakes. In the example we used, we had total assets of $325,000, which equals $265,000 in liabilities and $60,000 of owner's equity. So everything here balances perfectly. Okay, so that is how you read a balance sheet. Now I'm going to show you how to analyze this balance sheet so that you can make wise financial and business decisions. But first, let's talk about number 5. How do you create a balance sheet? So typically you create a balance sheet when you do bookkeeping. So when you're doing your bookkeeping, you're looking at all your transactions. So you're looking at what items you should categorize as revenue and what items or transactions should be categorized as expenses. And at the same time, you're going to be categorizing what you buy that could be considered to be assets and what you receive that would consider to be liabilities. Now, if you're doing bookkeeping yourself, which most self-employed people do, okay, then the tool I recommend you use is Quickbooks. Quickbooks Online can integrate with your business bank account and help you automate the bookkeeping process, thus saving you time and money from paying someone else to do it. All right, now that you understand what it takes to create a balance sheet, let's move on to number 6. How to analyze a balance sheet. So when you're analyzing a balance sheet, you want to evaluate each category and try to improve it strategically. Of course, the first category is number 1, cash, because cash is the bloodline of a business, and without it, it dies. And so here, what we want to do is make sure the company does not run out of cash and it can meet its current debt obligations. So if we look at our cash position, then we can see that we have cash on hand of $50,000. And if we look at our current liabilities of account payables, we have $100,000, which basically means that we need to pay $100,000 to our vendors, let's say within the next 90 days. But we currently only have $50,000 cash on hand. So then we need to go back to our assets and say, okay, where is the money going to come from to be able to pay off these current liabilities? Well, looking at our accounts receivable balance, we can see that we have $100,000 that we can expect to collect usually within the next 30 to 90 days. So we can expect to use our accounts receivables to pay off our accounts payables. So during our first analysis, we already know that we can meet our current obligations and liabilities. Now with this one, we want to look forward and make sure, okay, the company is in a position or not in a situation where they run out of cash and fail to meet future obligations. And to do this, we need to take a deeper look into accounts receivables. And what you're going to want to see is something called an aging schedule, okay? And this is going to give you a breakdown of that $100,000 of accounts receivables and the time frame of how long it may take to turn that into cash. So it's going to look at, is it 1 to 30 days to convert it into cash? Is it 31 to 60 days? Is it 60 to 90 days? Or is it never, right? And then you'll have a good handle on your likelihood of running out of cash for the future. And with that, you can turn to your first key business decision and ask yourself, okay, what can you do to speed up your accounts receivable, right? Like maybe that means you would need to put in a new system, or maybe that means you need to accept a different form of payment, or maybe you need to hire someone who can easily and consistently follow up with customers on their payments. Okay, next let's analyze number 3, inventory. So when it comes to inventory, you want to make sure that what you have in inventory isn't nearing expiration or becoming obsolete. Because even though we made up an inventory balance of $75,000, that doesn't mean that it is all going to sell and convert into cash, especially if you have products that have a high turnover rate, like food products, for example. So this could be more of a qualitative analysis where you're trying to figure out how likely it is that you're going to convert your current inventory into cash within the next 12 months. Because again, this is going to tell us the financial strength and the cash position of the company for the future. Next, we have number 4, long-term assets of $100,000. And here we want to ask ourselves, okay, are any of our long-term assets becoming obsolete? Meaning like you don't have any long-term assets in your balance sheet that you no longer need. Like maybe it's a piece of equipment that you no longer use. And if that's the case, of course, you want to remove that from your long-term assets category and potentially move that into your inventory category to sell so that you can liquidate and improve your cash position. And the key thing you want to analyze here is looking at a complete composition and a breakdown of all your assets so that you can determine the future economic value they have to your company. Okay, now that we have covered assets, let's look at liabilities. And the first thing we want to look at is number 5, our account payables of $100,000. And the big thing here is to determine the DPO, or the days payable outstanding. Okay, this will basically give you an average of how long the company takes to pay its vendors. And each company has its own unique payment cycle. And maybe it's within 30 days, maybe it's within 60 days, or maybe 90 days. And typically what you want to do is extend the cycle to be longer so you have a cash flow advantage. Next on the balance sheet, we had accrued expenses of $25,000. And here we just want to make sure that we have a schedule and we are properly accruing all expenses. Then next, under our current liabilities, we had deferred revenue of $50,000. And these again are going to be upfront payments from customers. And for this, we just want to make sure we make good on our obligation to deliver to our customers. So as we're evaluating this number, it's going to give us valuable insight in terms of what we need to produce in the future. And here is the main thing to be aware of with the long-term debt. Okay, you want to know what is the total breakdown. So you want to check the loan balances and the maturity date so you know exactly how much time you have to pay off the loan and plan your cash flows accordingly. And then lastly, shareholders' equity is going to give the owners valuable insight in terms of how much equity they have in their business, just as a homeowner would be able to evaluate how much equity they have in their primary real estate property. All right, now let's move on to the final section of this video and look at number 7, financial metrics, which can help you get a better understanding of the financial position of your company from different angles. Okay, one of my favorite financial metrics, or KPIs, to use is going to be the debt to equity ratio. So here, what you can do is take the total debt or liabilities you have. In this case, we had $265,000, and then divide that by the total equity we had, which in this case was $60,000, which gives us a debt to equity ratio of 4.4, which basically states that the company has 4.4 times more debt than equity or stock in the company. Generally, a safe debt to equity ratio is 1 to 1.5. So anything more than that can indicate that the company is in a startup or growth phase, and the company is primarily using debt to finance its long-term expected growth. And if that's the case, then the next financial metric that becomes more important is the interest coverage ratio, which basically shows you how many times the company can cover interest payments from earnings in a given period. So here you would take your total earnings or your total profit and then divide that by the total interest expense, which you can find on the income statement. And of course, as long as the profitability can cover the interest on the debt, then you should be able to continue to support fast growth. Now, you should know that there are 3 categories of ratios that help you really analyze the balance sheet, and we just looked at 2 under the category of solvency ratios. But also you have liquidity ratios such as a quick ratio, which helps you to determine, okay, if you are able to meet your short-term obligations, and you can find this out by subtracting your current assets from your inventory and dividing that by your current liabilities. And then next you have financial or capital ratios, which one of my favorite being the debt to asset ratio, which basically helps you measure how much a company's assets are financed by debt. And for this, you would do a very simple equation. You would take your total debt and divide that by your total assets. So in this video, I'm going to reveal the biggest tax mistakes I see business owners making all the time. I'll take a look at what the most popular mistakes are, how to correct the mistakes, or even better, make sure they don't happen at all. And if you stick until the end, we'll look at a framework for managing your tax situation. All right, let's dive in by first explaining number 1, what it means to be compliant with the Internal Revenue Service, aka the IRS. Now, the first thing you should know is that under Title 26 of the Internal Revenue Code, it allows the IRS to conduct what is known as a compliance check on you. Okay, these checks help determine whether or not a taxpayer is adhering to record keeping and information reporting requirements. Now, just to be clear, a compliance check is not, I repeat, it is not an investigation or an audit. Rather, it is a tool to help educate taxpayers about their reporting requirements. Now, during a compliance check, the IRS will review information the taxpayer is required to file or maintain, such as filing 1099 forms, filing W-4s or W-2s, and then filing 940s and 941s, and making sure you maintain those records. Now, if the IRS wants you to go through a compliance check, you should know that you can refuse and there is no penalty for not participating. That being said, not being compliant is the biggest tax mistake any business owner can make. But let's go a little bit deeper with mistake number 1, too many cash transactions. Look, it's not illegal or make you not compliant with the IRS if you have cash transactions. But if you are constantly receiving cash or paying with cash, it makes it much harder for your business to keep and maintain the proper financial records. For example, when you are using a lot of cash for qualified business expenses, then you have to keep track of and likely organize all your receipts from that merchant, because during tax time, what you're going to want to do is write off those expenses to reduce your taxable income. And you need some type of paper trail of receipts or documentation to be able to substantiate your tax deduction. Or if you are using a lot of cash to pay other people like your contractors, then you're going to need to manually log and have your workers sign off on each transaction and each payment, which is just another hassle. But again, this is something you want to do so that you can write off your contractor expenses and save your business on taxes. On the other hand, if you are receiving a lot of cash payments, well, of course, that makes it difficult for you because now you have to manually keep track of all the cash payments you are receiving and make inconvenient trips to the bank if you want to store your cash safely. Now, also, you should know that one-time large cash transactions that exceed $10,000 may be flagged at your bank and need to be reported to the IRS through Form 8300. Which makes handling a lot of cash transactions even more difficult. Now, some people, for whatever reason, think that they can avoid taxes by using cash, But think again, okay? What I like to remind people of is this, okay? Your income is usually someone else's deduction, and your tax deduction is usually someone else's income. Okay, so what exactly does this mean? Well, for example, if you pay someone with cash, then that's an expense to their business. And unless they just want to pay extra taxes, then they will write off that expense. And vice versa for you, right? Like if you pay someone with cash, you still want to reduce your taxes by writing off that cash payment, such as your contractor wages or your office supplies. And of course, the IRS can reference the tax returns and see that this company is writing off an expense related to your company. Okay, so then how can you correct or avoid this mistake? Well, this one is pretty easy, okay? You should, number one, consider setting up a business bank account where you have a digital ledger of all your transactions. And number two, when possible, you should use your business account or your business debit card or your business credit card when you purchase qualified business expenses or receive payments. All right, let's move on to mistake number two. No system for bookkeeping. Too often I see new business owners operating from their personal accounts, which creates a big mess at tax time. But look, I get it, right? Because you're ready to launch your business, the money is already in your personal account, so why not just use that for right now? But listen, as a business owner, it would be nearly impossible to know exactly where your business stands financially without segmenting your business and personal finances. So again, make sure you get your business bank account set up, but don't stop there. You need to understand business metrics for yourself, such as what products or services are driving the most sales, what your biggest expenses are and where you can cut back if you need to, how profitable the business is by looking at your net profit margins, and what your assets and liabilities are, which help determines the overall business worth. So how can you correct or avoid this mistake? Well, what you want to do is set up a system with consistent bookkeeping that happens, in my opinion, at least every quarter. Now, the bookkeeping system that we use and recommend is Quickbooks. Quickbooks Online can integrate with your business bank account, which allows you to import all your transactions. Then you can go inside Quickbooks and categorize things as needed. So with consistent bookkeeping in place, you can take the time to actually, review your business financials each and every quarter. Plus, it's going to help you maintain compliance with the IRS by having good records and completing the necessary tax forms. Also, if you have any questions about this or anything else in this video, please ask them in the comment section below. Okay, let's move along to mistake number three, not paying quarterly estimated taxes. Here's the thing, okay? When you work for someone else as an employee, your taxes are automatically withheld and paid by your employer to the IRS and state agencies throughout the year. So for most employees, this is why they pay little to no taxes when tax returns are due. But for business owners, it's a little bit different. Since you are the employer and the employee of your business, you need to make sure you are paying taxes quarterly throughout the year. The IRS basically prefers to get their money throughout the year than at the end of the year when you file your taxes. Okay, these are called quarterly estimated tax payments. And if you don't make these quarterly tax payments, then the IRS is going to assess big time penalties and interest on the tax that you owe. This can easily be thousands of dollars. Okay, on the screen right now is a schedule of the deadlines for quarterly estimated payments for the 2022 tax year. Now, how much should you pay in quarterly estimated payments? Well, it depends on your taxable income. Now, there is a form called 1040-ES that helps you calculate what you should pay in quarterly estimated taxes. But a simpler method that I like to recommend is simply paying 110% of the prior year's tax quarterly. So for example, if your tax liability was $10,000 last year, 110% of that would be $11,000. So you can break up that $11,000 by 4 quarterly payments and pay $2,750 per quarter as your quarterly estimated tax payment. So how can you correct or avoid this mistake? Well, if you happen to make this mistake for the first time, you can call the IRS and ask for a one-time forgiveness waiver. When you do this, the IRS may waive what is known as the estimated tax penalty. And in general, the IRS allows for this one-time forgiveness every 7 years. So it's something that you can't keep doing again and again. And of course, to avoid this going forward, continue to make estimated tax payments by mailing a check or going to the IRS website to make a payment. Which brings me to mistake number 4, not preparing employee or contractor taxes. So now that you understand how to take care of your taxes, now you need to focus on how to manage your employee or your contractor taxes as well. Let's take a look at contractors first. So a contractor is someone who works for you according to their own process and schedule. So if you have a contractor and you pay them more than $600 in one tax year, then you should be issuing them a 1099 tax form. By doing this, you are able to substantiate and write off your contractor expense for your business. In addition, the contractors then take the 1099 form and use it to report their income on their taxes, which is also great for the contractor in the case that they need to get approved for a loan or when they buy a car or a house, so that they have some records of the income that they made. Now, you can set up contractors and pay them right inside QuickBooks as well. Now let's quickly look at employees. So employees are people who work for you, and you are able to control the manner in which they work and their schedule. So when you have an employee, as we mentioned, then you are the one who are responsible for withholding their taxes. The first step in doing this is that the employee must complete a W-4 form to indicate to you as the employer how much taxes they want to be withheld. Then you would submit that to your payroll, which, by the way, QuickBooks has a payroll component as well. And with that, you can withhold the appropriate amount. And then at the end of the year, the employees will receive a W-4 form to report their income and substantiate your expense. Also, if you provide services for your clients, then they may hire you and consider you to be contractors for them for tax purposes. So they may send you a 1099 form as well to report on your business taxes. All right, moving right along to the 5th big tax mistake LLC owners make. Number 5, not filing business taxes. A popular saying is this: the only things that are certain in life are death and taxes. And yet, I don't know why, but almost every tax season, I run into business owners who have failed to file their taxes for multiple years. Everything's all right, nothing to worry about here. But listen, if you made income and you owe taxes and you failed to file your tax return, then you're going to face serious penalties and interest, which makes your tax liability much larger. And at the same time, it puts you on the radar with the IRS. And even worse, if you are found not to be compliant and you owe taxes, then the IRS can put a tax lien on your property or assets. But look, I promise I get it, because being a new business owner is difficult enough, and having to worry about all the tax things that you need to do can be a struggle. However, taxes don't have to be difficult at all. In fact, I have structured this video to where if you avoid the mistakes before this one, then when tax time comes, it is as simple as just entering in your financial information, answering questions, and then sending your tax return to your federal and state government. So then how can you correct or avoid this mistake? Well, again, if you happen to make this mistake for the first time, then you can call the IRS and ask for a one-time forgiveness waiver. That may help waive all the interest and penalties. And of course, to avoid this mistake going forward, you need to make sure you are filing your taxes on time each year. Okay, the 6th big tax mistake LLC owners make is number 6, not tax planning. Okay, the major problem with tax preparation is that it is not proactive. The goal of tax preparation is not to reduce your tax liability, but rather the goal of tax preparation is to make sure you file your tax return correctly and take advantage of as many tax deductions or credits that you qualify for based on what happened last year. On the other hand, tax planning can help you create more tax deductions or tax credits based on the current year. Now, as an entrepreneur myself, I am constantly looking at the costs and the ROI of doing different things, and tax planning is no different. So for me, if I wanted to invest in tax planning, then it needs to be worth my time and my money. Now, luckily, with tax planning, there is an actual ROI, which, by the way, ROI stands for return on investment, because tax planning is one of those things where you can spend money and actually get money back. Okay, let me explain this further by looking at two scenarios. Okay, scenario number one is a tax preparation scenario. So let's say, for example, you earn about $100,000 in net income or profit, and as a result, you owe about $15,000 in taxes. Well, with tax preparation, your cost would look something like this. Okay, you would have a tax payment of $15,000 plus $1,500 to pay a tax preparer for filing your business tax return. So your total costs are $16,500. And if you don't plan, then you could end up paying the same cost again next year. So that's scenario number one. Now let's look at scenario number two with tax planning. So with tax planning, let's say that you're able to identify in the next tax year, you will owe $15,000. And because you know that, you start proactively trying to implement tax strategies now to help you reduce your tax burden. But you're busy, so you decide to hire a tax professional to help you for $3,500. And that tax professional is able to help you save $10,000 by implementing different tax strategies. Well, with tax planning, your total cost would look something like this. Okay, you would have a tax payment of $5,000 instead of $15,000, plus a $3,500 tax planning fee and a $1,500 tax preparation fee. So simply by tax planning, you were able to bring your total cost down from $16,500 to $10,000. But that's not all, because now every year going forward, you're going to be able to save at least $10,000 without paying for another tax plan. So the next tax season, your total cost will be even lower, from $10,000 to $6,500. So before tax planning, you were paying $16,500 every tax season, and after tax planning, you are now paying $6,500 every tax season. That's a potential lifetime savings of $10,000. So what would you do with an extra $10,000? Tell me in the comment section below. But here's an option for you, okay? What if you decided to invest the extra $10,000 and got a 7% return over the next 30 years? That would turn into $1 million. So the true ROI of tax planning is crazy. Now let's move into number 7 and look at a tax framework to pull everything together. So when I start a new business, this is how I set up my taxes. Step number 1 is I keep track of all my records, both physically and digitally, with bank accounts and digital documents stored on my computer. Step number 2 is I perform bookkeeping with Quickbooks. Step number 3 is I make my quarterly estimated tax payments. Step number 4 is I set up employees and my contractors on QuickBooks or on payroll. Step number 5 is I perform tax planning. Step number 6 is I file my business taxes, and then I repeat this cycle every year. And so today, what I want to do in this video is help you identify what makes a great tax accountant. So I'm going to go over the difference between a tax preparer and a tax strategist, what questions you should consider asking before you work with any accountant, and what to expect in terms of pricing. All right, let's go ahead and dive in with number 1, what most accountants do. So let me give you some context of education so you know how to choose the right accountant. So in general, you learn how to do accounting by going to college or university, and what we are taught there are the technicalities that go into good accounting best practices. This will be stuff like creating and analyzing financial statements, how to properly categorize transactions and journal entries, business law and ethics, and overall, how to be compliant with the government or the IRS. And usually, if an accountant decides to pursue higher education, such as a master's degree or a CPA license, then they would go even deeper on these same topics. And so a lot of education is geared toward how to be an accountant inside of a corporation, but not a small business, which makes sense because college is very expensive and graduates want to get paid a great salary after they graduate, which big corporations can usually afford to offer.
offer. But a portion of these accountants, whether it's after they graduate or after they work in a corporation for a few years, decide that, hey, I want to go out there and start my own accounting firm. And so then they start working with a few new entrepreneurs and small business owners, like maybe you. And so a lot of accountants focus on, hey, give me your P&L, give me your tax forms, and let me prepare your tax return, which is great. Everyone needs that. Every small business owner should be filing their taxes on time and accurately. But the problem is most accountants think their job is done after that. All right, Sean, your tax return is prepared. I'll see you next year. But that's just tax preparation, right? And that's exactly what most accountants focus on. That's the compliance piece. That's what we're taught in school. But what about tax strategy? Because there are things that you should be doing throughout the tax year to properly prepare for your next tax season so you are paying fewer taxes. For example, you could be looking at ways to maximize deductions or change up your legal entity structure or different retirement strategies, insurance strategies, illegal tax loopholes, and so on. Which is why when I'm talking to people about working with us, they say stuff to me like, man, I have to tell my accountant about the tax strategies I'm learning on this YouTube channel. Or man, my accountant didn't even know about this tax loophole. Or my personal favorite, I only hear from my accountant during tax season. And so that's something that you should know as you select who you are going to work with. All right, let's move on to the second part of this video with number 2, what questions to ask your potential accountant. So if you are in a position to book a discovery call with an accounting firm, which by the way, sometimes that can be difficult, especially during tax season, because every accountant is busy during tax season, and if they're not, then that's probably a red flag as well. Like every tax season so far, unfortunately, we've had to stop accepting new clients simply because we reach full capacity. Anyway, if you are lucky enough to book a discovery call, then here are some questions I want you to consider asking. Number 1, directly ask, do you offer tax planning? All right, not tax preparation, but tax planning. And if their answer is they wait until tax season to help you save on taxes, then that's a red flag, because either A, that accountant doesn't know what they're doing, or B, and even worse, they are not doing things legally and can land you in big trouble with the IRS. In fact, let me tell you one quick story. So for years, my dad and I worked in an office park doing tax returns, and one tax season, a new accountant had moved into that office park. And so his firm was getting tons and tons of new clients. And my dad and I were like, man, what kind of marketing is this guy doing to get so many new clients? Well, it turns out he was getting his clients huge tax refunds, and word got around town fast. But guess what? He was doing some very shady and illegal things. And fast forward 6 months later, after tax season had ended, he left the office park and we never saw him again. And for that next year or so, we had tons of his past clients knocking on our door asking, hey, have you seen so-and-so? I have this letter from the IRS. He really messed me up. And now I have these penalties, I have these interests, and I can't find him anywhere. And of course, we didn't know where he went either. So we ended up having to work with a lot of his past clients trying to solve this huge mess that he created. So I always tell people to work with a good ethical accountant, because if you don't, it's going to cause you more headache, more inconvenience, and more money in the long term. All right, sorry about that quick side story. Let's get back on track. So ask them if they do offer tax planning. If they say no, don't expect any proactiveness from them. Okay, they don't do tax planning. They're just gonna do your taxes and push you off. If they say yes, then challenge it a little bit with question number 2 and ask directly, how much tax savings do you see on average for your clients? And you want to hear a solid, confident number, okay? You don't want to hear, well, it depends, or I have to look into that and get back to you. No, like for us, I can tell you pretty quickly that on average, our clients are saving somewhere between $15,000 to $20,000 in additional tax payments. Now, the next question, if you're feeling really challenging, is to ask them question number 3. What is the most amount of tax savings they found for one client? That might give you an idea of what level of skill they have when it comes to tax planning. Okay, question number 4 would be, Do you work year-round? You may be surprised to find out that many accountants only work during tax season, which typically is from January till about the beginning of May. And this could potentially be why it takes your accountant so long to get back to you during the off season. Even local tax franchises start to close around June-ish. So that's very important for you to know up front. Now, what are some bad questions to ask, right? Well, you don't want to ask a very technical question on a discovery call like, should I be an S corporation? Because that requires more information and more research on you, right? Because in some cases you should, in some cases you shouldn't. It really does depend. There are many factors that go into making any tax recommendation, which is why it's something you should work with someone one-on-one on who totally understands your business and your personal financial situation. Now, another question many people may ask is, are you a CPA? Which is a fine question, but that doesn't give you enough insight into how they work and if they can strategize with you. Like I said in the intro, just because someone is a doctor doesn't mean they are the right doctor for you. And the last question I don't think is super helpful for you to ask is, are you local? Because the federal tax code is where you pay most of your taxes, and generally the state follows the federal. And these days, work is remote, and a great tax strategist can help you anywhere if you're in the United States. All right, so those are some questions to think about asking and maybe some to steer away from. If you have some on your list that I didn't touch on, make sure you tell me down in the comment section below what question you think is very important you ask a tax accountant before you work with them. All right, let's go ahead and move on to the third part of this video with number 3, what to expect with pricing. So when you find a good tax accountant, what should you expect to pay? Let's go ahead and start off with tax preparation. So when you are an individual and you're just filing a 1040 return, then typically you're gonna pay somewhere in the ballpark of $300 to $1,000. And that $1,000 upper limit is really reserved for people who have a lot of things going on, like some rental property, maybe some stocks, some crypto, and so on. Now, when you are filing a business tax return, the price really starts to shoot up somewhere between $1,000 to $3,500, which really depends on if you are a single member LLC, an S Corp or C Corp, if you have any other partnerships, and so on. So that's tax preparation. On the tax planning side of things, according to a survey from Intuit, tax planning can cost 5 times more than tax preparation. So on the super low end, it costs about $2,500, and on average, I think it costs about $5,000. And on the high end, I mean, some people will charge you 1% of your total revenue, which means if you're making $1 million or more, then you should expect to pay $10,000 and upward. Now you may be thinking to yourself, man, I don't know, Sean, I don't think I need any tax planning. Well, I want you to consider this, okay? Many small business owners overpay in taxes simply because they don't know how to leverage the tax code like the rich and the wealthy do. Think about former President Trump, for example, and how he almost paid nothing in taxes, but we know he makes millions of dollars. So yes, tax planning may cost $5,000, but what if you save $10,000, $25,000, $50,000 in additional tax payments? What would that mean for you? Okay, usually that means a positive return on investment. So this is something where I don't want you to just think about the cost, but also think about your returns. All right, and lastly, when it comes to ongoing tax consultation or tax advisory, on average, that's about $175 per hour. But for really experienced tax strategists like myself, my rate starts at $500 an hour, and more experience means more money. All right, so I hope the video was great. I'm a bit sick, so I know my words sound a bit muffled. Please forgive me on that, and I hope you could tolerate some of my shameless plugs. Coming up next, I have 2 more videos you may enjoy as well, so check those out if you haven't already, and I'll see you over there.